What is going on, guys? Thanks for joining my channel, Robinhood. This is Bob. Today is Tuesday, August 25th, and today we are going to go over just about everything you need to know about selling calls. Today's video is inspired by my subscriber, Kerry Martinez. Me and him share a passion of SPG, Simon Property Group. If you are familiar with my video, you know a big part of my portfolio is in Simon Property Group. He actually carries 440 shares of it. So I was just trying to talk to him about making some money with that by selling calls instead of just holding on to it. So we did exchange emails, and I did walk him through of getting a couple of calls done on that. So that is what we are going to do today. So the example I'm going to use is going to be a Jets ETF. So this is a little bit of a lower stock price that people can do and not hold up too much of their money. So let's go to the trade. So there's a buy, a sell, a call, and a put. So today we are going to be talking about selling a call. You can also pick the expiration date. I usually like to pick the closest expiration date for the most part, just because with the world we're in now, we're not sure what's going to happen. So I like to pick the closest thing, especially with the COVID and especially with this particular stock with the travel section. So what is a selling a call? Selling a call option, you're giving the buyer the right to purchase the stock at a specific price, known as the strike price, with a set expiration date. So basically this means you're bearish. You think the stock will go down or stay below the strike price. So the strike price is a set price at which a contract can be bought or sold when it's exercised. For call options, the strike price is where the security can be bought by an option holder. Selling a call, the stock has to stay below the strike price, not to be exercised. So this is the strike price here. As you can see, I did do 3 options at $18 strike price expiring August 28th. I did get $15 per premium for this per option I did, so I did get $45. So this is the strike price here. So all this means is I'm picking a price when you're selling a call that you are willing to sell the stock at if it reaches or exceeds that price. So my hopes selling a call at this price is that it will not reach $18. So the next thing we're going to talk about is the break-even price. So the break-even price is the stock price at which investors can choose to exercise or dispose of a contract without incurring a loss. So basically a buyer, you got to make sure that a buyer can actually close the contract early or before the expiration date as well if it hits that number. So when you're doing these and it hits the number and you're hoping it goes back down, they can close it out at any time if it reaches that point. So when you're looking at the break even, all this means is whatever the share price the premium is at, it's just going to be added to the strike price. So if I did have to sell this stock and it was at $18.15, the share price at this time, I basically would break even. So anything higher than this, $18.16 or higher, I would be losing money. Anything lower than this price, even if I sold it, I technically would be in the money. But for the most part, what most people want to do is for this not to be exercised. So anything under $18 is great because you keep the premium, you keep your shares, and you can basically do it all over again. So the next thing is going to be the chance of profit. So chance of profit refers to the chance of making at least 1 cent on a trade. So the higher percentage, higher chance of profit usually means less premium than a higher percentage. So what this means is that the percentage here is 78%, so you get a $15 premium on average. And then if you go up to a higher percentage at 86% chance of getting a profit, it's only $8. But if you go to here to 66%, which is already at $17.50 right now, you're getting $35. But you also look at your break even at $17.85. So I usually play it pretty safe, so I stick around the 80 to 90% range when I'm doing the stocks, especially in a short-term range. So I'll get a little bit less premium, but it's somewhat guaranteed. Like I said, 78% right now. I believe it was like 85% when I first did it. but 78% still pretty confident that it's not going to hit $18 by the 28th. So the next thing is the percentage of change. Percentage of change is a comparison between two values expressed in the hundredths. A negative percent of change indicates a decrease from original value to the second value. A positive percentage indicates an increase from the original value to the second value. So the percentage of change of the previous value, like the previous trading day. So if you look here from yesterday, from today, the premium has lost 34.78% of where the average was yesterday. So this will get you to the next thing of the change. So the change is the difference between the current value, so the value what it is now, and the previous day's market close value. So -8. So what this means is that -8 has dropped down 8 cents from yesterday. So this used to be 0.23, which would have gave you the drop of 34.78%. So the next thing is going to be the price. The price is the buyer of the option. Contract pays the right to buy or sell a security at a specific price in the future. This is also known as the option premium, money that you get for that particular option. So when you do look at this, this is basically just the average of what people are going to go. So there's a bid and an ask, but this is just the average price that you're going to have. You don't have to pick this particular price. You can enter in really whatever price that you would like. They're kind of just giving you this one to, kind of pick one that will be executed pretty quickly. So the next thing is going to be the bid and the ask. So the bid is the price that represents the maximum price that the buyer is willing to pay for a share of the stock or other security. So basically it's the highest premium that you can get at that moment that it's bidding. The ask is the price that refers to the lowest price a seller is willing to accept in the share of the stock or other security. So it's the lowest premium. So you look here, you see the bid. There are 884 people bidding at $10, 10 cents, but you times by 100, so it's $10. And then the ask is the highest. So there's 250 people asking for 20 cents or $200. So the mark is the next thing we're going to go over with. Mark is an option is always the midpoint between the bid and the ask prices. It's just the average of the bid and the ask price. So the mark is 15. So it's 10, 20, half of that, in between is 15. So 15 of the mark is probably the highest chance that you will make the most money and it'll be executed. So these people asking for 0.20, it's a high chance that it's not going to happen unless the stock keeps on going up and up and up. And the people that's asking for the bid, there's a possibility, higher chance I would say, that people get on the low end than the high end, because a lot of people don't want to wait around to see if the stock is going to be executed. And if they're really sure that the stock is not going to be executed, they're probably just willing to take the profit and not worry about exactly if they're going to lose an extra $5 or not. All right, so the next thing is previous close. It's always refers to the prior day's final price. So it's the prior trading day option premium. So you look, the previous close was at $23. So this was at 0.23, 23 cents times 100 is $23. So if you look here, it's at 15. So it was at 23 yesterday, it's at 15 now. That's why you're getting the change negative and the percentage change here at negative. All right, so the high and low is the paid option premium at the highest and lowest latest trades. So the high here was $36. So today someone purchased this share for $18 strike price for 36 cents. So it's $36. And then on the low side, the lowest that someone actually got paid for was $10. So whoever got this $36 has made out already 50-60% already on the profit. So I don't know how many shares they bought at that price, but whoever got that price had the ultimate deal for this moment here, because it's even higher, way higher than the previous close at $23. So from going from $23 at the previous close to $36 to being an average of 15 and the low of 10, whoever got this particular trade has made out pretty good already. And the next thing you want to go over is the volume. So the volume is the number of option contracts traded in a given time period. So the volume here is how many people are waiting. So you see how many people here are bidding, how many people are asking, and there's always people in between. So people are doing 11, people are doing 15. So there's a lot of people in between. So this is how many people, this is how many people that's already traded already. So it's 966 people have made bids, asked, and has been executed. So the open interest indicates the total number of option contracts that are currently out there but not executed. So these are people who are bidding. So these are the people who are bidding high, low, and in between. So there are 2,130 open interests out there, but only 966 people has made trades on here. So the implied volatility represents the expected volatility of the stock over the life of the option. As expectation rise or as the demands for a option increases, implied volatility will rise. Options has high levels of implied volatility will result in a high priced option premium. So decrease is good for the seller, increase is good for the buyers. So this next thing here is the Greeks. It does get pretty complicated here. So I'm just going to go over some few examples and definitions for it. So the Greeks is a term used in options markets to describe the different dimensions of risk involved in taking an option position. So the first of the Greeks is delta. So delta, gamma, theta, vega, and rho are the Greeks. So delta is an estimate of how much an option premium may change given a $1 move. So example of an option of delta of $10 in delta is at 0.5. So if the option is at $10 and delta is at 0.5 and the stock increases by $1, the option goes to $10.50. If the stock decreases $1, the option goes to $9.50. And this is just guesstimates. This isn't in stone. This is just guesstimates on the delta. So the gamma is the rate of change of an option delta based on a single point move in delta's price. So an example, we'll use the $10 again. So if the option is at $10 and delta is at 0.5 and gamma is at positive 0.1 and the stock goes up $1, so the new option is still at 10.5, but then the delta will be changed because you have to add the delta plus the gamma would be 0.6. So the new delta would be 0.6. So theta is an estimate on how an option price will decrease with each passing day. For an example, an option price at $5 with theta at negative 0.25 in 10 days, if nothing changes in the stock price, the option would be valued at $2.50 at the option price. So this is basically just the decay of how much it should go down in per day. So the vega is an estimate of an option price will change with 1% change in implied volatility. So an example, if the option price is $5 and implied volatility is 50% and vega is plus 0.5, so this is implied volatility. So if it goes up 1% to 51%, expected option price, it would be $5.50. So you would just take the option price plus the vega, because it's in a positive, would give you the 550. But if it went down 1% at 49%, the option would be, expect the option price would be $4.50. So it's $5 minus the 50-cent vega because it went down. And the last one, a lot of people do not pay attention to this because it's such a very small percent. But I'll just give you the definition. It measures the sensitivity of a option or option portfolio to a change in interest rate. So if nothing happens, if everything stays the same, it just gives you how much interest rate it should change over a period of time. So just a quick short here. My way to do option trades on here to sell a call, if you're going to sell a call, what I like to do is to wait for a green day. Because if you wait for a green day, the premium will be higher. Because if you wait for a red day, let's say it goes down 3%, and then you're picking $33, and then it has a green day and goes back up 3%, just balancing out people, selling and calling, then you're already in the negative already. So I usually like to wait for a green day, or I'll wait a day before it expires and just try to get as much as I can do out of it. So let's say if today was Thursday and it was at 1750, I still would not pick the 1750. I would probably go up just one notch. And even if this was at $5, I would be willing to take 3 options at $5 than nothing at all. So I usually take the safe route doing that way. So that's just my point of view on how I like to do the option trading. If you guys have any other questions or something I didn't answer for you guys, definitely hit the comment below and let me know. And if there's any other videos you want me to do, also put that in the comments. If you guys like this video, please hit the like and subscribe. Like I said, I did hit my 50 subscriber. I'm trying to get to the 100 soon. Thank you guys. Have a good day.